There's no free lunch. There's always a price. Some countries carry eye-watering public debt, yet they aren't in crisis. Others with far lower debt to GDP are forced into default or restructuring. Why? The answer isn't just how big the debt is, it's the revenue behind it. Debt is paid with revenue, not with GDP. Debt distress is about whether governments can pay interest and roll over maturing debt from their revenues. The key pressure gauge is interest to revenue and debt service to revenue, not just debt GDP. If revenue is broad, reliable, and growing, high debt can be managed. If revenue is thin or collapsing, even moderate debt becomes dangerous. 3 pillars explain the difference. 1. Revenue capacity, tax and non-tax revenue as a share of GDP. Big dependable revenue bases make debt service budgetable. 2. Financing terms and structure. Local currency versus foreign currency debt, who holds it, at what maturity and interest rates. 3. Liquidity. How much must be refinanced each year, and whether there's a deep market or a lender of last resort. Let's put these to the test. We start with the high debt, low distress cases. 4 countries bear scrutiny: Japan, France, Italy, and the United States, plus Canada as a North American example. First up, Japan. Japan carries one of the highest debt ratios globally, but much of it is yen denominated, held domestically with central bank support. Crucially, its interest bill is small relative to a large revenue base. Result: high stock, low stress. In fact, Japan could probably take on more debt safely. Interest to revenue is a mere 6% today, similar to when debt to GDP was much lower. What about France? Here, revenues are already very high relative to GDP, even before factoring in recent windfalls from carbon pricing. Add in the very long average maturity of its bonds, and France looks rock solid. Even with substantial debt, interest to revenue stays below 10. Italy also does well here. While debt is high overall, much is long dated and fixed rate, which slows the pass-through of recent rate hikes. The cushion isn't as comfortable as France's, but revenue and structure keep the pressure in check. That leaves the United States, which benefits from deep dollar markets and a broad economy. Despite rising interest outlays, interest to revenue remains within funding capacity because the tax base is large and financing access is robust. But what about Canada, which has many of the same advantages as the US? Its debt to GDP ratio is lower, but interest to revenue is modestly higher because revenues are notably higher than in the US. So all 4 of these countries plus Canada combine high revenues with good debt structures to stay well clear of trouble. High debt doesn't mean distress if revenues are robust. Now let's look at the other side of the coin. Lower debt that lands countries in distress. 4 cases fit this bill: Ghana, Sri Lanka, Ethiopia, and Malawi. They come from different regions and have different challenges, but all 4 have revenues too small to cover interest payments comfortably. Let's start with Ghana. This chart tells the story. Interest payments at one point consumed a very large share of government revenue. With revenue to GDP in the mid-teens and significant external currency exposure, debt service to revenue spiked, leading to distress and restructuring. Sri Lanka's case is related. In 2019, the government cut taxes, causing revenue to collapse. With low revenues, high external debt service, sustainability unraveled, culminating in a default in 2022. Recovery hinges on rebuilding the tax base. Ethiopia fares no better. Its tax to GDP is in single digits, among the lowest globally. Even with debt ratios below advanced economy highs, cash to service debt is scarce, and FX constraints add pressure, hence distress and restructuring talks. Finally, we have Malawi. Here, revenues remain very low while interest costs are relatively high, taking a large chunk of available resources, squeezing room for basic services and pushing the country into debt distress. These 4 examples show that even very low levels of debt can be unsustainable if revenues are too small and debt is costly and/or FX heavy. We've seen that debt distress is really about revenue strength, currency, and maturity structure, and refinancing needs. When we put these factors together visually, the picture is unmistakable. Countries with sound revenue, financing, and liquidity positions can carry a lot of debt. Those with weaker fundamentals face distress earlier and at much lower levels of debt. That's why some countries can run up massive debt stocks without ever suffering a crisis, while others hit distress with just a fraction of the debt. This is not a call for profligacy, but it is a reminder that debt sustainability is about much more than just the debt-to-GDP ratio. Looking solely at debt levels can be misleading, giving a false sense of security to countries with strong revenues and low refinancing needs, and understating the risk in countries with weak revenues and maturity or liquidity mismatches. So what should policymakers do? Our playbook has 4 items. First, raise and stabilize revenues by broadening tax bases, reducing exemptions, improving compliance and cutting wasteful spending. Second, lengthen maturities and localize debt by developing domestic currency markets. This reduces refinancing and FX risk. Third, manage liquidity by smoothing gross financing needs and building buffers. Fourth, support growth sustainably. When growth outpaces interest costs, debt dynamics improve. To illustrate, consider Ghana again. Here's what it would take to bring down debt to GDP to more sustainable levels. Raising revenue alone would require a primary surplus of 7% of GDP for 6 years, a huge undertaking. By contrast, a more promising approach is to keep revenue and GDP growing in line with interest payments. Interest costs will stabilize at 5% of GDP, allowing the debt ratio to gradually decline. But this requires policies to boost growth, such as improving business climates, investing in infrastructure and education, and diversifying economies away from commodities. If you think of the government budget as a seesaw, you can see that our 4 policy actions tilt the balance in favor of revenue. Raising revenues directly adds weight to the right side. Improving growth increases the weight on both sides, tilting the balance through the interest channel. Extending maturities and localizing debt reduce refinancing pressure, freeing up room on both sides. Managing liquidity adds flexibility, allowing the government to balance spending across time. Every country faces a trade-off between running deficits to boost demand and collecting taxes, which dampens demand. But history suggests that running smaller deficits is the better bet, especially with interest rates rising. More revenue also reduces the need for borrowing, which puts downward pressure on yields. Lower yields mean lower debt service costs and more fiscal space, creating a virtuous circle. Consider the experience of Ireland in the aftermath of its 2008 property crash. Ireland's government took on large debt as it bailed out banks and raised spending to support the economy. This pushed the debt-to-GDP ratio from 20% in 2007 to almost 120% in 2013. But instead of trying to roll over this mountain of debt, Ireland focused on raising revenues. It broadened the VAT base, simplified tax bands, and introduced a property tax. By 2021, the debt-to-GDP ratio was back down to 65%, and the interest burden had fallen from 10% of revenue to 2%. Ireland avoided a debt crisis by focusing on its revenue capacity. Of course, tax increases aren't politically easy, especially when growth is slow. But Ireland's experience shows that focusing on revenue is essential for long-term debt.